Hello, everybody, and welcome to Pay Tax Once for S-Corporation owners. So, again, specifically S-Corporation owners. Today, you're going to discover how to avoid hundreds of thousands of dollars of future income taxes by utilizing this one simple strategy used by banks, Wall Street, billionaires, and your peers. So if you're an S-Corporation owner and you're roughly age 40 to 55, earning in excess of $250,000, keep listening. I'm going to give you this information at absolutely no cost. It's 100% free, and you're going to love it. So if you believe in challenging conventional wisdom and traditional wealth accumulation and distribution strategies, if you believe that taxes are likely going to increase in the future and increase a lot, and you don't want to pay them, this strategy is absolutely for you. And by the way, if you stay to the end, I'm going to give you free access. You're not going to have to pay anything. Free access to a calculator so you can see what you're on pace for in retirement. It kind of looks like this. You're going to be able to look at what does perpetual taxation look like and versus pay tax once. It's a huge difference. So perpetual taxation versus pay tax once. You're also going to see the increase you can receive by avoiding future income taxes legally using the tax code. This particular section of the tax code has been used for decades. So in this video, I'm going to show you how to avoid hundreds of thousands of dollars of future income taxes by utilizing, one simple strategy that's used by banks, Wall Street, billionaires, and your peers. I'm going to briefly discuss three approaches to building wealth according to traditional, and I totally believe outdated, planning methods. And I'm going to expose the three biggest and costly tax problems of traditional planning. And more importantly, how to avoid them. It's easy. People have been doing it for decades. You're going to find out for the first time perhaps today. So let's dive in. And by the way, I'm Stephen White. I've been doing this for 18 years. And like many of you, I enjoy the outdoors. I like spending time with family. I love golf. I love fly fishing. And more importantly, I've been self-employed for 28 years. I totally get the tax game. And I truly want to avoid paying taxes more than once, all according to the tax code. So let's look at the pay tax one mindset. Let's get ready for this. We got to think about what is it that we want in the end, right? Dr. Stephen Covey said in his famous book, 7 Habits of Highly Effective People, begin with the end in mind. Know about what you want in the end so you can back into it and even have a better plan. So let's look at this. You're a business owner and you are being offered to purchase another business. Maybe there's 2 businesses out there that somebody wants to sell you. And just based on this little information, business A is going to pump out roughly $5 million of gross revenues, which is going to give you $200,000 a year in taxable income. Business B is pumping out $3 million of gross revenues and paying you $180,000, and it's all tax exempt. You are not required to pay taxes on that money. Which one would you want to purchase just based on this information? If you checked off business B, you're in the right mindset. Keep listening. If you didn't, this is not going to help you. The rest of this will just be a bunch of noise to you. So let's roll. When we look at our accumulated wealth, I break it up into this pie chart. All of our net worth is inside this circle, but it's kind of divided. We've got our lifestyle, the money that provides us with our lifestyle. We've got transfers, and the transfers are monies leaving our ledger unnecessarily or unknowingly, or both. And then we have our accumulation. Now, I want you to pretend in your mind, if you had your druthers, and Uncle Sam says, yes, if you have all of your net worth in this pie, you don't owe us any taxes. You're not required to pay taxes on that. That's the tax law. So if this was a pie, and I gave you the knife, how big a slice are you going to carve out that you want to share with the taxing authorities? Well, if you said 0 or none, you just make one little bitty slice, keep listening. But if you gave anything bigger than that, I'm not so sure that the pay tax once mindset's right for you. So let's keep going. The 3 ways of accumulating wealth. The first way is the always taxed bucket is what I call it. Always tax buckets are considered income tax when the money comes out of these. You're familiar with qualified plans. You're exactly right. Qualified plans, we defer our income, but we're also postponing taxes on that money. But it's considered income when it comes out. And when you have income, you have an income tax. So if you're dealing with a 401k, a SEP IRA, a profit sharing plan, a cash balance plan, you're not in the pay tax one mindset. Again, we might be deferring our income, but we're also postponing taxes. Who the heck knows what the tax rates are going to be, right? To add insult to injury, you're providing 100% of the funding, you're taking 100% of the risk, you're paying 100% of the costs, but you got to share maybe a third or a fourth of it with your business partner on the East Coast. You have no access without penalty or a tax before the age 59 and a half. So for those of you guys and gals under 50, you got to wait a really long time before you can access that money without really taking it in the shorts. So the first bucket, the always tax bucket, again, it's subject to federal and state income tax if you have a state income tax. Again, who the heck knows what taxes will be in the future? We just don't know. Up to 85% of your Social Security benefit could be taxed. It's a very low threshold. Again, Social Security tax is based on reportable income. So if you're reporting 60, 80, 100,000 of income coming out of a qualified plan, your Social Security is going to get taxed, folks. In addition to that, you possibly and could likely have what's called an IRMA adjustment. If you're not sure what IRMA adjustment is, just make a note, write that down, look it up after this video. Of course, after you take me up on my offer. I've seen Medicare premiums as high as $489 each for a couple. So dad's paying $489, mom's paying $489. That's almost $1,000 a month in Medicare premiums that people are paying. That's crazy. That's 12 grand a year, pretty darn close to 12 grand a year in just Medicare premiums. So where are you going to go to pay that? You're going to have to take more money out of your qualified plan. You could pay up to an additional $250,000 in taxes over your retirement lifetime, and you're going to get a 1099. 1099 means you're going to get taxed on the taxable amount that shows up in that one little box. Let's move on to the second bucket. I call this sometimes tax because it's an after-tax play. You're investing your dollars into a brokerage account or real estate or some sort of investment using money that you've already paid tax on. So you're only going to be taxed on the gain, and there's short-term and long-term gains, right? So your basis isn't taxed. That's the money that you put in. But again, here's another kicker. Up to 50% of your Social Security benefit could be taxed at your marginal rate. The other kicker is you're possibly going to get another IRMA adjustment on your Medicare premiums. Capital gains tax rates, according to the tax code 2023, I haven't seen the 24 yet, but if you're under 400,000 modified adjusted gross income, your long-term tax rate is 15%. If your modified adjusted gross income is over 400,000, the tax code says you got to pay 20% on those gains. I've seen the long-term capital gains rate as high as 38%. You have to dig deep into the history, but it's there. So the federal capital gains tax, here's a question for you. What's it going to be 5 years, 10 years, 15 years from now? I don't know. But all I know is if these folks back on the East Coast want to increase that tax rate, I surely don't want to participate in having to pay those, and neither do you. And the other kicker is, the last one is, we're going to get a 1099 for the money that we took out of that account. It's going to show how much we took out and how much of it's taxable. And that's, again, that's paying taxes more than once. We don't want to pay tax more than once. Again, on these accounts, you're providing 100% of the funding. You're taking 100% of the risk. You're paying 100% of the costs. How can this be a good deal? How can bucket number 1 or 2 be a good deal? Tell me. Show me how that can be a good deal. We've got a business partner who doesn't offer any value, and yet we could be writing checks for a third or more of our net worth every time we go to spend it. I don't like those odds. Paying a partner for doing nothing. So let's look at the third bucket, the never taxed cash flow account. And this is the pay tax once account. This is the coup de grace of where you can put your money to pay tax once. So what I'm saying is this. You earn your money, you pay your taxes. We're in the lowest tax rates we've been in a number of years. Put your money elsewhere. It can grow on a tax-exempt basis. And when you go to use it, there's no taxes due because it's considered cash flow. So what's considered in bucket number 3? Well, we've got Roth accounts, but you still get a 1099. I don't know why we're getting Roth accounts on I don't know why we're getting 1099s on our Roth accounts, but the government's surely tracking them. Could it be that they can change the Roth rules? Maybe, maybe not. I don't know. But I do question, why are we getting a 1099 on a tax-free account? Another cash flow considered, not income, not gain, is a margin account loans. Some of you may have a margin account. Margin accounts is where you pledge certain assets, certain securities to get a loan from your wirehouse to go buy more securities. If you want to know what the good and bad of a margin account is, go back and watch that movie called Trading Places. Reverse mortgages. It's non-taxable. Money coming out of a reverse mortgage, again, is considered cash flow. The Internal Revenue Code says, no, we don't tax cash flow. Any kind of loan is tax exempt. All loans are considered a transfer of capital. It is not considered income or gain. Therefore, it's not taxed. The last piece here is called a limited pay whole life contract. And the limited pay whole life contract, some of you may be familiar with them, but you may not be all the way familiar with them. A limited pay whole life contract provides tax-exempt cash flow to you. And I'm going to show you a couple examples. But the limited pay whole life contract is the instrument that we predominantly use for pay tax once accounts. So again, no taxes due in bucket number 3. It's considered cash flow. Again, we use limited pay whole life contracts. You don't get a 1099. And if it's your only source of money in retirement, in other words, all you're receiving is Social Security and money from your third bucket, your pay tax once account, the Internal Revenue Code says, you know what, you don't have any other income. We already know what your income is because we send you a Social Security check. So as of today, current tax code says if all your income is Social Security, you're not even required to file a return. And you can check with your CPA on that. They'll tell you the same thing. There's also no IRMA adjustments on your Medicare premiums, right? So instead of paying, like my one client, almost $12,000 a year for Medicare premiums, you're still paying the basic minimum each. It's what, $135, $145 each. That's a significant difference. That's a huge pay raise for you in retirement. And you're not paying the $250,000 of the Social Security. So no tax on your Social Security benefits at all. Again, tax on Social Security has to do with income and gain that you're reporting. So let's look at an example here. I'm going to give you some assumptions. We're going to look at $2 million in each bucket. We're going to consider a 4% safe distribution rate. You can look this up too. If you just go on your internet and do a search for what is a safe withdrawal rate in retirement coming out of my investment, you're going to see anything from 3.5% to 4%. And they use what's called a Monte Carlo simulation or a Trinity study that says, hey, if you're a retiree, you can pretty much take 3.5% to 4% out of your account every year, don't exceed that, to give you roughly a 97% chance that you will not run out of money. 97% chance, that's pretty good. But still, you're limited to 3.5% to 4%. Let's also consider the households receiving $45,000 in Social Security. So bucket number 1, and if you want to talk more about this, you certainly can. I'll give you the granular. But bucket number 1 is going to net you about $88,000 a year. Bucket number 2 is going to net you about $113,000 a year. And bucket number 3 is going to give you $165,000 a year. And these are net numbers. These are $88,000 after tax, $113,000 after tax. And we're basing this also off of an average 25% tax rate. So you may be more than 25%, you may be less. But in this example, I'm using a 25% total tax rate. Bucket number 3, here's a little caveat. Distribution rates on bucket number 3 are ranging between 6 and 7% based on real life case studies that I've done over the number of years in this business. And the reason why you get that 6 to 7% higher distribution rate has a lot to do with volatility and market movement and the fact that there's no fees dragging down that money. Nothing wrong with fees, but it's part of the game. So if we look at number one again, $88,000 a year, income tax, 113 capital gains, and in your tax exempt, never tax, pay tax once account, you're looking at $165,000. That's significant, folks. That's significant. And I'm here to ask you today, which one would you want? If you could have it, which one would you want? If you pick number three, keep on going. We're just about done here. We're going to dive into a couple of case studies. So case study number one. Before they came clients, an S-Corporation owner and his wife wanted to change their advisor. He was not happy because his current advisor was not being responsive enough and failed to provide any useful value. My client was concerned about future tax increases, and he wanted liquidity, access, and control of his money. Didn't want to wait till age 59, but he wanted that access now, that control now. He wanted to pay tax once. He was a gentleman that was just sick and tired of paying taxes 2, 3, 4, 5 times on his after-tax money. He wanted to pay tax once, one and done. Done with it. The only advice that he got from his advisor, and this is interesting, was max out your SEP IRA contributions and you'll be fine. Really? Max out my SEP IRA contributions. Oh, that's perpetual tax. And who knows what taxes are going to be. Maxing out a SEP, my client's going to be paying taxes for the rest of his life once he enters retirement. And he has no access to his money before age 59 and a half. He didn't want that. He just wanted to pay his taxes once, one and done. So let's fast forward to today. He set up his pay tax once strategy. He's positioning 6 figures of his after-tax dollars into his pay tax once strategy. His plan is targeted to be funded, fully funded, with $1.1 million in about 10 years. His estimated annual retirement distribution is on schedule to produce $78,340 of 100% tax-exempt money, resulting in a 7.1% distribution rate. 7.1 is way higher than 4%, and that's 7.1% totally tax-exempt. No taxes due. So let's compare this to the pay tax forever strategies. So let's just assume the same amount of money, $1.1 million, 4% safe withdrawal rate. It's going to give him $44,000 and change before tax. If his combined tax rate is 25%, again, we don't know what the tax rates are going to be. His net is approximately $33,000. Using gross numbers, we take that $44,000 to $78,000 and change that his pay tax once account gives him. That's a 77% increase in cash flow. That's huge. The guy gave himself a huge pay raise just by shifting strategies. That's all he did. And it's all tax exempt. Again, I'm going to hammer this. It's all tax exempt according to U.S. tax code. His distribution from his PTO strategy, I call it, will not trigger income taxes on his or his wife's Social Security benefits either. No trigger, which could save them up to $250,000 during the retirement years. That's an extra $250,000 that they could have back into their pockets. That's a lot of money. He also has access to his money in his pay tax once account if he needs it or wants it before age 59 and a half. Without penalties and without taxes. He just picks up the phone, gives us a call. Hey, here's the account, send it. He gets it in 5 to 7 days. No questions asked. Just which account do you want me to put it in? And again, anytime he wants. Doesn't matter. So again, he paid taxes once. He created his pay tax once account, one and done. He's good to go. He's off to the races. So let's look at another strategy. And you'll see that the pay tax once strategy is scalable. It can be as little as you want or as much as you want. This next strategy, before this person became a client, again, an S-Corporation owner, asked me if there was something that he should be doing that he's not. And I thought that was a great question. He was angry because he was paying quarterly taxes on his brokerage accounts, on the realized gains, and on some of the unrealized gains because he had some mutual funds. And you can talk to your accountant about that. Yes, you can get taxed on mutual fund accounts even if you don't sell your shares. I think that's kind of weird, but it's how it works. He was also concerned about giving away huge chunks of his wealth to future taxes. He wanted liquidity, access, and control of his money. He had some projects he wanted to work on. He didn't want to have to liquidate, and certainly did not want to go to the bank and ask for a loan, even though he could get it. But he wanted access to his money without penalty and without tax. In a short period of time, we set up and implemented his pay tax once strategy. Same kind of strategy, again, used by Wall Street, banks, financial institutions, and his peers. He's positioning 6 figures of investments and 7 figures of money market accounts into his new pay tax once strategy. His plan is targeted to be fully funded with $3.8 million in about 8 to 10 years. His estimated annual retirement distribution from his pay tax once strategy is on track to give him $263,000 in change every year. 100% tax exempt. Again, all according to U.S. tax code. His distribution rate is 6.9%. It's not 7.1, it's 6.9. But that's a heck of a lot more than 4% before tax. This is 6.9, no tax. So let's compare this to a pay tax forever strategy, paying taxes into perpetuity. 3.8 million times a 4% safe withdrawal rate. He's looking at $152,000 and change a year before tax. Again, before tax. Who knows what taxes are going to be, but if we base it on 25% income tax, his net paycheck is roughly $114,000 in change. Using gross numbers in comparison, $152,000 to $263,569 is a 73% increase in his retirement paycheck, and it's all tax exempt. I think he's pretty happy about that. So let's summarize this and get down to nitty-gritty so you can get moving on and having access to your free calculator. So I've showed you how S-Corporation owners can avoid hundreds of thousands of dollars in future income taxes by utilizing one simple strategy used by banks, Wall Street, billionaires, and your peers. Your peers are doing this, ladies and gentlemen. We discussed the 3 approaches of creating wealth using traditional planning models. We exposed the 3 biggest tax problems triggered by traditional planning and how to avoid them. So now is the time for you to take advantage of my free offer. Click the button below and you will have free access to our proprietary calculator. It's a basic calculator, but it's a calculator that you could use just to play with your numbers, your story. Compare your pay tax once forever money with having your own pay tax once account. So click the button below. We'll see you on the other side. Thank you for your time today. I hope to have an opportunity to talk to you. Have an awesome day or an awesome evening. Take care.